Okay, good afternoon and welcome back everyone to our options education webinar series. My name is Tony Zhang. I'm the chief strategist here at Options Play. And today we're going to cover a topic that I think a lot of option webinars kind of take a little for granted. Entering option orders and helping you manage positions. And this is really more of a beginner topic in the beginning, where we're talking about basics on how to enter an options order, how to close an options position. Something that many times, when we're talking about different option strategies, even basic ones, we don't really cover this part of trading, because a lot of times as traders ourselves, we kind of assume that people know how to enter orders, but we realize that not everyone has placed an options order before. So we want to take a step back from talking about actual strategies and talking about, what are best practices for cover calls and managing calls and puts and debit spreads and credit spreads, and really take a step back and say, if you're brand new to options trading and you haven't placed your first trade, how do you go about doing that? The mechanics of entering an options order, and also thinking about once you're in a trade, how do you go about closing that trade? So once we get through some of that, then we'll talk a little bit about how to manage different option positions and the different philosophies that we generally have as traders to show you what are best practices for managing an individual position. And that's more so for those of you that do have some experience trading or maybe have traded some options before, different strategies we're going to talk about how to cover managing those positions. So we're going to cover, a bunch of things today, everything from very, very basic beginner, option order entry, all the way through a little bit more advanced as to how to manage an existing trade. So let's go ahead and get started. Before I do, just a quick disclaimer. What I'm discussing here today is purely for educational purposes. It is not a solicitation or recommendation to buy or sell any specific securities. And for those of you that are brand new to Options Play, welcome. Options Play is a free platform available to everyone here in Canada. Not only do you get access to the platform for free as a partnership that we've done with the TMX, you also get access to bi-weekly options education webinars like the one that you're on today, free on-demand options video library so that you can take a look at all of our previously recorded webinars, as well as weekly cover call and short put reports. For those of you that like to sell cover calls and short puts, we identify when there are opportunities to generate income and allow and send that to you every single Monday morning. So, and you can sign up just using the link, which I have here on my screen, and as well as share that into the chat window. So for those of you that are brand new to Options Play and you don't have access to the tools that I'm showing you here today, please register. It is free to all Canadian residents. So with that, let's go ahead and get started. Here's what we're going to cover today. Like I said, we're going to start off with more of the beginner topics, which really is entering and closing option orders. So again, this is something that I think many educators take for granted, because many of us are either professionals or semi-professionals, and we do this for a living. So sometimes we take the basics for granted. Sometimes we forget to cover some of the very beginner stuff, like how to enter an order. So today I really want to take some time and break down an options order, because if you're a stock trader, there's only a few things that you need to worry about on a stock order. On an options order, there is a lot more things you need to pay attention to. And if you do any of those parameters wrong, you're likely going to trade the exact opposite trade. So it's important to know what are the parameters, how to enter them correctly. Once you learn how to enter an order, then you have to learn more about options liquidity, because again, it is quite different from stocks. You have to figure out exactly where you want to price an options order. So to do that, we're going to talk a little bit about options liquidity, talk a little bit about how to look at the bid-ask spread before thinking about where should you price an options order. Once we get through that, I think those are most of the beginner topics that we're going to cover. Then we'll talk a little bit about how to manage existing option positions. So these are option trades that you've already entered. How do you go about managing them? How do you decide when to close them out? And then lastly, I do get this question a lot from users. So when do you consider rolling a position? So if you don't know what a rolling position is, that's okay. We're going to cover that so that everyone gets an understanding as to how to go about doing so. Now, before I get started, I just want to get a quick glance of the audience here. Now, if you can bring up the chat window at the bottom of your screen, if you could please type 1 if you're brand new to options trading, and please type 2 if you have some experience trading options or you're an experienced options trader. Please type either 1 as a beginner or 2 as an experienced options trader, just so I can get a quick sense of the audience here in the room. Okay, so I see predominantly 2s, but I do see some 1s here. So for those of you that are 1s and you're brand new to options trading, the first half of this webinar is more for you. And for those of you that have more experience, the second half of the webinar is going to be a little bit more geared towards those of you that have a little bit more experience. So let's go ahead and get started. Let's talk about entering an options order. Now, before you enter any options order, you must first establish a directional view on an underlying stock or ETF, because whenever you're trading options, your largest exposure is still the underlying stock. If the stock goes higher, if it goes lower, if it stays where it is, that's where you have the largest exposure. So it's first you have to determine, are you bullish, bearish, or perhaps neutral on an underlying stock? Now, what I'm not going to cover here today is specific strategies as to if you're bullish, what should you do? If you're bearish, what should you do? Because I have whole webinars just on that alone. And I highly recommend you to take a look at some of those previously recorded webinars if you want to learn more about those strategies. But based on your outlook, whether you're bullish, whether you're bearish or neutral, you have to select an appropriate options strategy to begin with that suits the bullish, bearish, or neutral view that you have. You have to select an appropriate expiration date, and then you have to select an appropriate strike price. These are all things that I talk about on the individual webinars on specific strategies. But once you have these parameters, that's when you can now start entering an order. So this is what we want to walk you through, how to enter that order. Now, the first thing that you want to know with option orders is that there are 2 types of orders. There are opening orders and closing orders. Unlike a stock where you can simply buy and sell, and most people presume that the buy order is an entry and the sell order is an exit. But in reality, you could also short sell a stock first by short selling the stock first and then buying it back later. You can do the same thing with options. However, when you're trading options, you actually have to specify whether this is a buy or sell to open, or this is a buy to sell to close. So whenever we're talking about entering an options order or entering an options position, we're always going to have to enter a to open order. And you can do this either with a limit or a market order, just like you can with a stock trade. So right off the bat, there's a few different things that you have to consider. Number 1, you have to think about which strategies do you want to trade, what expiration date, what strike price, and then make sure that you enter your orders as a to open order when you're opening the contract. And you want to make sure that you typically enter this either as a limit or market order. Now, once you've established a position, that's when you need to, or actually before you establish that position, you should have some plan of an exit strategy. And you should always have a plan with any options position that you're entering, an idea as far as when you're going to cut losses. So if you're bullish on a stock and the stock doesn't move in the direction that you expect it to, so you think the stock is going to move higher, but instead it kind of just stays where it is or maybe moves a little lower, so this expected move that you have does not materialize, you should have some point where you decide, okay, this is not working out. It's time for me to cut my losses. And you should have rules for both cutting losses as well as taking profits. That's a general rule of thumb that you should have with any option strategy that you're about to enter. But once you have all of those, that's when you're ready to place a trade. Now, when you place a trade, there's quite a few things that you need to consider. You need to consider whether you're buying or selling, the quantity, the expiration date, a strike price, whether it's a call or a put, and the price of that call or put. So right off the bat, as you can see, with any options order, you have 6 different parameters that you have to enter per leg. And this can get a little complicated if you're trading multi-leg orders. So if you have 2 legs, like the example we have here, that's actually 12 different things that you have to enter on a single order. And this is where I think sometimes it can get a little confusing. So this is what we want to walk everyone through here today. So just to reiterate, when you're trading options, you have to specify. Whoops, sorry guys. When you're entering an options order, you have to specify whether you are entering the position or you are closing the position. Oh, I apologize. Looks like people could not see me. Okay. Can everyone see my screen now? I apologize. So let me just backtrack 1 second here. I apologize. So this was the first slide. What I was saying is that what we need to first do is establish a directional view, either bullish, bearish, or neutral. And as a result of that, you have to select an appropriate option strategy, an expiration date, and a strike price, of which you are going to enter that with a to open order. And you can do that either with a limit or a market order. So when you do that, what you're going to get is an order that looks like this, where you have to specify whether you're buying and selling to open or to close, the quantity, the expiration date, the strike price, a call or a put, and the premium. So again, as you can see, there are 6 different things that you have to enter for a single leg of an options trade. If you have 2 legs, that's 12 parameters that you have to enter. 3 legs, 18. As you can see, this quickly gets very complicated, especially if you're relatively new to options trading, which is why it's so important to really make sure that you understand this and you're entering all of this correctly, because if you screw up even a single parameter, chances are you're going to be trading something completely different than what you had originally intended. So what you want to make sure that you understand is how to enter these things. So most of these things are predominantly already selected based on your strategy. So for example, your option strategy itself and the expiration date and strike price, which is determined by your underlying view of the stock or ETF, will help you determine your whether you're buying and selling. It will determine your expiration date, your strike price, and it will also determine your type. Now, the premium comes from the market. So the premium is not something that you have control over, but it's something that's actually controlled by the market. And then the quantity is determined by your risk tolerance. So whether or not you have the capital to trade 1 contract or 10 contracts or 100 contracts is based on your account size. So these are the different things that you have to account for when you're entering an options order. Now, when you enter that options order, like I said before, you have to specify whether this is entering an order or closing an options position. So whenever you're entering an order to enter a position, these always have to be a to open order. And so you can either buy to open or sell to open as an opening transaction, because you can either buy the option or you can sell the option. Now, in order to close the position that you then have, you have to trade the corresponding order to close that position. So if you bought a contract to open, you must sell it to close. If you sold the contract to open, you must buy to close. So you must trade the corresponding trade in order to get yourself out of a position. So for example, what I have seen sometimes happen is someone will buy a contract to open, and then when they're ready to close out that trade, they enter a sell to open as opposed to a sell to close. And what ends up happening is, instead of closing their position, they actually end up with a second position. Now they're short that contract that they were originally long. And that's not what you want, because instead of closing it out, now instead of having 0 positions, you now have 2 positions. So it's very important to make sure that you are selecting the corresponding closing position and making sure that your order is to close in order to truly close out your position. So it's extremely important that you get that correct. So here's an example here where we're bullish on a particular stock and we're buying a call option. So this is where we're going to buy to open because we're initiating a position. We have to choose a quantity based on our own parameters or our own account. We're going to buy a August 200 strike call option, and the current market price for that stock for that option is $7.95. So that's an example of a call option that we would buy in our account. So that is an example of an opening transaction. So one of the ways that options play helps you do this is we will actually specify for you the details on how to enter a trade. So when you're analyzing a trade within options play, any trade that you analyze, you can hit the trade button. And when you hit the trade button, what happens is we actually give you the details of the trade so that you understand how to enter these trades into your broker's platform. So when you hit the trade button, you'll see a page that looks like this. And what it will do is it will specify for you all of those things. So whether you need to buy to open, it'll also specify the quantity if you change it, the expiration date, the strike price, the call or put, and the current premium that it's trading at. Not only do we tell you what the current premium is, we also tell you what the bid-ask price of that option is so that you can get a sense for where you want to place your orders. Now, we will talk a little bit about this in the next slide as to where and when you want to consider placing your options order. But first, you want to make sure you enter your order correctly. You have all of these 6 parameters that you have to enter, and it's make sure that you enter them correctly before you can start taking a look at the price of an option. Now, once you're in a position, closing a position will vary heavily from broker to broker. And typically, most brokers, what they allow you to do is they allow you to select a current position. So many times you can go to your positions tab or your account holdings tab where you can see your current positions. And usually what you can do is you can select an option position that you're in, and usually you should have an option to close that position. And when you click on that, your broker should be able to populate a ticket that is going to be to close for the contract that you currently have open. And this could either be a buy to close or a sell to close, depending on whether you're long or short that option. But this is really how typically from most brokers' platform, they help you automate the process for closing a position. So sometimes we've seen this where, depending on your broker, sometimes they will roll up your options positions into a single symbol. Sometimes they will break down each individual leg based on a symbol, and you might have to choose multiple legs in order to close it. But again, it varies heavily from broker to broker. So if you're brand new to options trading, I recommend that you actually call your broker the first time you enter an options trade and the first time you close an options trade, and just have them walk you through how to utilize an online platform to open a trade and close a trade, because again, this does vary sometimes from broker to broker. So make sure that you talk to your broker about that. Next, what I want to talk a little bit about is options liquidity, because that's going to help us drive us towards the next segment, which we want to talk about. Where should you price your options on your orders? Now, before I do that, I just want to make sure that everyone understands the concept between a to open order and a to close order. If that makes sense to everyone, please type 3 into the chat window. I just want to make sure everyone understands that concept before I move on to the next segment here. Okay, great. I see a lot of 3s, which means that hopefully everyone understood the difference between an open order and a closing order. So next, let's talk about pricing on options, because options are not as liquid as stocks. So you have to think about where you place your option orders in order for them to get filled. So basically, when we're talking about options, anytime you go outside of the top 20 to 30 names, what that means is that if you look at the market cap of stocks, and anything that's not in the top 20 to 30 biggest names by market cap, which in Canada is predominantly going to be banking and a few resource stocks, oil and mining stocks. Outside of that, you're really going to see relatively lower open interest and volumes. A lot of people ask me, well, would I ever trade something that has a lower open interest and volume? The answer is yes. However, you need to be careful because these stocks or these options with lower open interest and volume typically have wider bid-ask spreads. And however, one of the things that I always tell users, when you see something with relatively low open interest and volume, that doesn't necessarily mean that it's not liquid, because the liquidity of an option is really a factor of the liquidity of the stock. So if the stock is liquid, then the options usually are just as liquid. Just that maybe not a lot of people trade the options on a particular stock. Maybe it doesn't move as much, but it doesn't mean that it's not liquid. So many times what we tend to see is that on the surface, the options may not look very liquid, but actually there's plenty of liquidity. And the thing is that open interest and volume sometimes is not a good gauge for liquidity. What's a much better gauge to understand whether something's liquid or not is to actually see where orders are executed. And the closer that an order is executed to the midpoint, the more likely that it's more liquid. So what we tend to see is that most orders are filled within 5 to 10 cents around the midpoint. So if you have a stock, and we're going to go through a few examples like this, but if you see executions where they are predominantly a few cents away from the midpoint, then you should be able to also see that you should be able to get your orders filled relatively close to the midpoint. If you can get filled close to the midpoint, then the options are fairly liquid. Regardless of how wide they're quoted, many times you see quotes that are very wide, but orders that are filled near the midpoint. So don't be afraid to place orders inside the bid-ask spread, no matter how large that spread is. Don't be afraid to try it out by placing an order inside the spread and see where you get filled. Worst case, you don't get filled. So that's a bit of some of my insights as far as options liquidity. But what I want to do is I want to go through some real examples. So options that have large bid-ask spreads, options have larger bid-ask spreads than stocks, but some of them are much wider than others. So many times when you look at the large cap names, so in Canada, the banking stocks, the mining stocks, the very large cap names and the names that are not very volatile, what you're going to see is that they typically have relatively small bid-ask spreads. So something like, let's say, you might see an option that's trading at 775 by 795. So that's a spread of 20 cents, right? So that's a spread of 20 cents. Let's use my drawing tool here. So this is a spread of 20 cents. Conversely, if you look at this spread down here, $9 by $2.50, that's a spread of $3.50. So significantly different spreads. And this example here on the bottom is more likely going to be either a small cap name or one of the more volatile names. So a lot of you that like to trade the marijuana stocks, you're going to see these very wide spreads in those marijuana stocks. And for those of you that like to trade banking stocks, mining stocks, the larger cap names, you're going to see smaller spreads. And what you really want to look at is the distance between the mid price and the order that you're trying to execute. So as you can see, the difference between the mid price and the asking price here is 10 cents. The difference between the mid price and the asking price here is $1.75. 10 cents versus $1.75. So the further away the ask price is from the mid price, the more you're effectively paying to execute this order. So if you were trading this option here on the top, you're trading 20 cents to buy and to sell on that whole round term. To buy and sell based on this lower price, you have to pay $3.50. So substantially more money to trade this one at the bottom. So where do you want to place your orders? And the answer is you always want to place your orders in between the mid price and the asking price, or the mid price and the bid price. And it depends on whether you're buying and selling to determine which one you want to use. So whenever you're buying any type of option, it doesn't matter whether you're buying it to open or to close, you want to make sure that you price your order in between the mid price and the asking price. So whenever you're buying, you want to be in this range. Now, if you're selling, it's just the exact opposite. And again, this doesn't matter whether you're selling to open or to sorry about that. It doesn't matter whether you're buying to open or buying to close. You're going to be, you want to use a sell order, which is going to be in between the bid price and the mid price. So here in this example, if I'm trying to buy an option that's trading between 775 and 795, I want to place an order in between those two prices. So if in between 785 and 795, naturally, I would probably start my order at around $7.90, halfway between the mid price and the asking price. And usually, this is only 10 cents away from the mid price, so which is why I'm using 5 cents. But if let's say this was instead of $7.95, if instead this was, let's say this was 785 by $8.50, I would still start at 790, maybe 795. What you basically want to do is you want to start as close to the mid price and work your way up towards the asking price. The further you go, the more likely you're going to get filled. The closer you are to the mid price, the less likely you're going to get filled. Now, what you want to do is you want to slowly work your way up to the asking price. And the asking price is effectively the last worst possible price that you want to pay. You always want to try to pay something less than the asking price. And if you're selling, you always want to sell at the highest possible price. So you want to price it closest to the mid price, maybe 783, 782, 780. And then if still it doesn't get filled, then you start moving to 778, 775. So that's how you go about getting an order filled. So if you're buying, you always want to pay the least amount of money, right? So if you're buying something and you have the option of paying $100 or $101, $103, you obviously want to pay the least, which is why whenever you're buying, you want to pay a price just above the mid price, as little as possible. If you don't get filled, and you want to get filled and you want to increase your probability of getting filled, you just basically offer to pay a little bit more, right? So think about any other item in the world. If let's say you walk into a store and you want to buy something, and you want to offer $100 for something and no one is willing to take your offer, and you say, okay, well, what if I paid 102 and still no one takes your offer? And you say, okay, what if I paid 105? Now someone's willing to sell to you. It's the same concept with placing an order in the marketplace. You're basically trying to discover where people are willing to buy or sell at. And you could do it by placing an order starting at the midpoint, which is kind of your best possible price, and working your way up as you get closer and closer to the asking price. The asking price is basically where the market maker has guaranteed that they're going to fill an order. $7.95 is where a market maker is saying, I'm willing to sell it to you for $7.95. You're just trying to say, well, can I pay a little less than $7.95? And that's effectively what you're doing when you're placing that options order. Now, if that makes sense to everyone, please type 4 into the chat window. The idea of placing a limit order close to the mid price and working your way out towards the asking price or the bid price, depending on whether you're buying and selling. Okay, great, a lot of force. That's exactly what I was hoping to get, because I know that that's not an easy concept to understand. And sometimes a lot of people get confused about the bid-ask price and what it means and how to deal with it. But you should just think about walking into a store and saying, well, they're asking $795 for this item. What if I offer them a little less? Would they take it? And that's effectively what you're doing when you're placing that limit order. And vice versa, when you're selling, you're basically saying someone's willing to pay $775, but what if I'm only willing to sell it for $780? Will someone pay me $780 for it? And that's exactly what you're doing when you're placing that limit order. And when we're talking about spreads that are this close to each other, 20 cents, that might not mean a whole lot. But when you're looking at an option order, that's where you're priced like this, where you're having a large spread like $9 by $12.50. What I basically think about this is that this is a market order this is a market maker that's basically putting out pretty much garbage quotes, meaning they're not really interested in soliciting orders. They're waiting for other people to come in and offer a better price. You know, when someone's placing a $9 by $12.50 a quote out there from a market maker, that means they're not really interested in dealing in this. And what they're basically asking you to do is, you know, start making some offers. You know, offer them $11, offer them $11.50. I bet most of them will deal at those prices, but they're not willing to quote that. You have to go and discover it yourself. So when you see these large spreads, don't be afraid to place a limit order. You know, don't let the fact that it's a large spread scare you away from trading. You know, don't be afraid to do a little price discovery. You know, say, well, guess what? I'm not willing to pay $12.50, but I'll pay $11 or $11.20. See if anyone bites. Many times you'll see that the market makers will bite, especially if the stock itself is relatively liquid. So keep that in mind when you're placing these orders. So that covers, you know, my kind of segment on placing option orders and how to price your options orders in the market. Now, what I want to start talking about and transitioning to is talking about once you're in a trade, how do you manage them? Now, what I have is a few different types of positions that you typically, as a trader, will find yourself in with respect to options and how to generally manage them. And this is something I do cover more in the individual topics for those of you that want to learn more. But I'm going to start by talking about the option selling strategies, so cover calls and cash secured puts. This is predominantly where most of you are trading with respect to options. So cover calls is probably the number one. Cash secured puts is probably the number two in terms of most popular option selling strategies. So I'm going to cover these two first, and then what we'll do is we'll cover some of the other strategies like buying options. So whenever you're selling options like cash secured puts or cover calls, these are both strategies that you have limited reward with potentially a huge amount of risk to the downside. So it's important to understand what are your options when you're in these types of positions. So on a cash secured put, the goal of a cash secured put is to simply acquire the shares that you want to buy at a discount. So you should only be selling cash secured puts on stocks that you want to buy. If you're selling cash secured puts or short puts on a stock that you don't want to buy, that's not a position that I generally recommend you to be in. So when you're selling a cash secured put, this is the simplest possible option strategy to manage because it doesn't require any active management. This is really the only strategy in the textbook that doesn't require you to manage a position once you've entered it all the way through expiration. Because when you sell a cash secured put, there are only two possible outcomes. Either expires worthless, which means that you can rinse and repeat the strategy again and sell another cash secured put, or it gets exercised and basically you now own the stock that you wanted to own at the strike price minus the premium that you received on the cash secured put. So once you sell a cash secured put, you, unless your view on the stock changes, you basically can let it go and expire. And at expiration, one of two things will either happen. And you should be comfortable with either one of those two possible outcomes. With a cover call, it's a little different. Cover calls are a way to strategically exit the stocks that you own and generate some yield on those assets while you own them. So when you sell a cover call, you have three possibilities. The stock can either move substantially higher, it can move sideways, or it can move substantially lower. Those are the three possible scenarios. And in the first scenario, when the stock moves substantially higher above the strike price that you've sold on the cover call, this is really where I see a lot of people panic because you see this unrealized loss on the short call. You're about to get your stock called away. You're not sure what to do. And this is where I see a lot of people panic because they see that a large unrealized loss. And I've seen people buy back the call because they don't want to lose the stock. Now, there's nothing wrong with buying back that call. However, if you're going to do anything like that, like buy the call back or sell another call and roll that cover call, the rule of thumb here is that you only want to do that within the last week of expiration. Whether you want to roll it, whether you want to exercise that, whatever it is that you choose to do, you want to wait until the last week. Because if you don't wait until the last week, then what you're not doing is you're not giving the stock the possibility of it going below the strike price before expiration, and you're not capturing the time premium of the short option that you're selling. So you're basically locking yourself into a loss, and you're not giving yourself the opportunity to potentially gain some of that time premium back and give yourself the opportunity for the stock to actually fall back below the strike price by expiration. So whenever the stock goes above the strike price, you want to make sure you wait until the last week before you do anything like buying that cover call back. If the stock moves sideways, this is your best case scenario. You simply want the call to expire worthless, and you want to rinse and repeat. This is where you do absolutely nothing, and once the cover call expires, you sell another cover call. If in the event that you sell a cover call and the stock plummets, this is the only time where you want to do something early, because if the stock plummets, then you should be able to buy back the call that you've sold for a relatively small amount of premium. And the rule of thumb here as to when you should do that is if you can buy back the call at 20% of the premium that you originally collected to begin with, that's when you want to buy back a call. So if you sold the call for $1 and you can buy it back for 20 cents or less, it's time to consider taking profits on that trade, selling another cover call, and generating more yield before the expiration date even came up. This is really the only time, in a cover call trade where you would do something early. So that is the general rule of thumb as to how to manage cover calls and cash secured puts once you're in those trades. Now, when you're buying an option, such as when you're buying a call or a put, or if you're buying a debit spread, this is where the rule is a little different. Whenever you're buying options, number one, you generally want to close out these positions prior to expiration. So, and you should really close it out either at a gain or a loss prior to expiration. And the rule of thumb here is pretty simple. And I like buying these types of trades because of how simple the rules are. Number one, you want to cut losses when you've lost 50% on any single trade that you've purchased. So on an option that you've purchased, a call or a put or a debit spread, if you bought it for $1 and it's trading at 50 cents or less now, it's time to cut your losses and move on. Because if you've lost 50% on a long option, that means the expected move that you had on that stock or ETF did not materialize. And it certainly did not materialize fast enough. So it's time to cut your losses. And I get a lot of questions from users where a trade goes against them and they ask me, well, should I buy some more and dollar cost average and maybe buy myself some more time? And my answer is you should never double down on a losing trade and increase the portfolio risk on a losing trade. That's my rule of thumb. Because if you start doubling down and start increasing your risk, that's when you can find yourself in a pretty big hole, and you don't want to do that. On the flip side, if a trade starts to go in your favor, you also want to have rules. You want to take profits at somewhere between 75 and 100% gain. So if you bought an option for $1, now it's trading at $1.75 to $2, it's time to start taking profits. At the very least, start taking partial profits. So if you're trading multiple contracts, take half of it off. You should be able to effectively reduce the entire trade you should be able to reduce the risk on the entire trade down to close to zero if you follow these types of rules, and still have the other half of the trade left for it to continue moving in your favor. And the only time that you want to roll a position, and I get a lot of questions, a roll just simply means closing out an existing position. So if, let's say, you're long some call options, rolling it means selling those call options that you've bought and then opening up a new position in a single order. So if, let's say, I own the November calls and November is approaching and I want to still remain long that stock. So what I want to do now is I want to roll them into a December or a January call. So what I'm doing is I'm effectively selling the November calls that I have, and I'm buying December or January calls. Now, if I do all of those two things in a single order, that's what we call a roll. So when we roll, we can either roll up or out. Up means we're rolling to a higher strike. Out means we're rolling to a further expiration. You only want to do that when you have extended targets either in time or in magnitude. Now I'm going to go through a few examples of this to show you what I mean by that. I don't necessarily expect everyone to understand that just by the text itself. So what I have is a few different scenarios to show you when it makes sense to roll a position. Because generally speaking, if a trade goes against you, the rule of thumb is cut your losses. But if a trade goes in your favor, you have quite a few different options. So what I want to do is I want to explore what those options are for those of you that do trade options to see, how can you reduce your risk on trades, but still maintain that upside. So I have a few different scenarios. The first one is I'm bullish on I have a target price on a specific options trade, but my target price has not been met yet. So what can I do? So here's an example where I bought 10 contracts of let's say the stock is trading at $100 and I have a target price of 110. So what I have is, as a result of the fact that it's a $100 stock, I have a target price of 110. So I bought 10 contracts of the 100 strike calls, so the at the money calls. And let's say I paid $3 for those calls. So this whole trade cost me $3,000 because 10 contracts times $3 a contract is $3,000 for 10 contracts, and I have a target price of 110. Now, let's say 3 weeks into this trade, the stock moves in the direction that I expect it to, but it hasn't quite reached that 110 target yet. It's only gone halfway. And I still have a few weeks left, but the trade is going in my favor, but it hasn't quite reached my target yet. So the stock moves up to 105, and I have 3 weeks left to expiration. So let's say I still think the stock may head to 110 by expiration. I'm not 100% sure of it. There's some chance that the stock may pull back. So what I want to do is I want to position myself for that move higher, but I also want to be able to reduce some risk. So one of the rules that you can do here, one of the things that you can do is you can simply close out half your position. This is a really easy way to protect yourself from potential downside while still allowing your positions to take advantage of more upside. So whenever a stock goes in the direction that you expect it to, but has not hit your target, you can utilize this strategy. So what I'm doing here is I'm going to sell half my position. So I originally had 10 contracts. Now what I'm going to do is I'm going to sell 5 of those contracts. And because the stock has gone in my favor, originally what I paid $3 for is now trading, let's say, for $6. So when I sell half the contracts, half the position off, I'm collecting $3,000 because 5 contracts at $6 per contract nets me $3,000 in credit. And what that's going to do is I'm going to reduce my risk from $3,000 down to 0 and still keep 5 contracts on for a move higher. And what that means is that if the stock continues to move higher, I'm going to be able to take profits. If the stock continues to move higher, I'm going to continue to make more money on my specific trade. But in the event that the stock corrects back lower, whether it corrects $1 lower, $5 lower, or maybe $10 lower, my risk is now reduced to 0. So no matter what happens, I cannot lose any money on this particular trade. I can only make more money if the trade continues to go in my favor. Now, if the trade doesn't go anywhere, I basically am flat on the trade and I don't make anything on this particular trade. So that is the downside, okay, is that if the stock doesn't go anywhere from here, I make nothing, but I actually lose nothing. So this is one of the ways that you can manage a position that's gone halfway in your favor, but you still think is going to continue going higher, but you want to do this by removing all the risk. And this is really great for those of you that want to reduce the risk in the remaining position. And this does require you to have at least 2 to 3 weeks left in the trade, because if you only have a few days left, this doesn't really work out for you. You have to basically take profits on the whole thing. But if you have 2 to 3 weeks left, you can basically position yourself for more upside without taking any risk on the overall trade. The second position, trade here is when you need a time extension. So you might find yourself in a similar position where you have a $100 stock. You think the stock is going to move higher, so you buy. That's in this example, we're buying 10 call options as well. And basically, what happens is you get this modest directional move up to 105 with 3 weeks left to expiration, but you decide that you need extra time. Maybe you need an extra month. So you bought the October calls, and as they approach expiration, you realize that this trade did not move as fast as you expected to. Maybe there's some event after October that has now come, that you are now made aware of, that you weren't aware of when you originally entered the trade, and now you're thinking, well, I'm going to need till November expiration for this move to happen. So what can you do now if you need more time? So if the stock starts to move in your favor halfway through, and you realize that now you need maybe an extra month to get to the same target price that you originally had. So what you can do here is you can take the original position. So here we bought 10 contracts of the October 100 calls for $3. So we spent $3,000 on this particular trade. Now, because this trade has gone a little bit in your favor, you can sell the entire trade. Now, the 10 contracts of the October 100 strike calls for $6 and collect $6,000. So your net profit right here already is $3,000. Now, because you still think the stock is going to continue moving, what you're going to do is you're going to take that money, the $6,000 that you've received, and what you're going to do is you're going to buy November calls with it. Now, because you're buying November calls, it's further out in time, they're going to be more expensive. In order to buy November calls, because November calls are more expensive, let's say in this particular case, they're $7 as opposed to the $6 that you sold the October calls for. Now you can only buy 8 contracts. So originally you owned 10 contracts. Now you can only buy 8 contracts. So what this does provide you with is an extension in time to reach your target. So now moving from October all the way out to November, the only downside that you have to this is you've decreased your leverage, because originally you owned 10 contracts, now you only own 8 contracts. But you were effectively able to buy yourself an extension without risking any more money, and you actually reduce your risk a little because you collected $6,000 on the October calls. You only spent $5,600 to buy the November calls. So you actually reduce your risk by about $400. So not only did you reduce your risk by $400, you bought yourself a whole nother month without spending any more money. So this is one way that you can roll a position to give yourself a little bit more time on a specific trade. And lastly, if you do find yourself in the lucky position where you have that same $100 stock and you believe that it's going to move to 110 over a month's period of time, but you get a really quick move to the upside. Maybe there's earnings, maybe news came out, something unexpected where you just got a move to the upside very, very quickly. And now, instead of just thinking it's going to go to 110, maybe you think it's going to go to 115 or 120. So because of this unexpected news event or earnings or whatever it is, you now have a raised target price. So you get a quick directional move to 107 with 5 weeks left to expiration. And now you have a new target price of $120. So this is, again, it's a good scenario to be in, but how can you protect your profits? How can you get yourself or leverage yourself for additional upside? So originally we bought 10 contracts of a 100 strike call for $3. Now what we're going to do is we're going to sell the whole position. We're going to sell all 10 contracts. Let's say they're trading at $10 now, so we're going to collect $10,000. And what we're going to do is we're going to take that $10,000, we're going to buy a higher strike call. So instead of originally we bought the 100 strike call, now we're going to buy a 110 call. Now, because we're buying a higher call, they're going to cost less money because the 100 strike calls we sold for $10, we're going to buy the 110 calls for just $5. So what we're able to do here is we're going to buy a higher strike. We're actually going to be able to buy more contracts. So originally we only bought 10 contracts. Now we can buy 15 because they're cheaper. We're buying a higher strike call. And by buying this higher strike call, not only are they cheaper, we're going to be able to buy 15 for even less money. So our net on this trade is we're actually receiving a $2,500 credit, which offsets the $3,000 that you originally paid. So now what you've effectively done is you've maintained long exposure with lower risk, because instead of risking $3,000 on the whole trade, now your total exposure is only $500. You've increased your leverage on the trade because you've gone from 10 contracts to 15 contracts, and you've close to doubled your position sizing, and you've effectively reduced your overall risk from $3,000 to $500. And what you've done is you've basically bought yourself a higher leverage. So if this trade does move up to $120, you're going to make even more money, because instead of just owning 10 contracts, you now own 15 and you have less risk on the overall trade. So these are all different ways that you can modify an existing position when it starts to go in your favor. And what you're going to notice is a theme here. I only talk about rolling positions when a trade goes in your favor, because that's actually the only time it makes sense to adjust a position. If a trade is going against you, I always advocate it doesn't make sense to roll your position or adjust your position, because what you're doing then is you're actually adding on more risk. You can only take risk off if a trade is going in your favor. You can't take risk off if a trade is going against you. So keep that in mind. When a trade goes against you, it's best to just cut your losses and move on. And when the trade does go against you, you have a lot of options to really protect yourself, allow yourself to extend the trade, buy yourself more time, buy yourself more upside, and at the same time, reducing your overall trade. That's what you should be focusing on as a trader, is adjusting trades when they start going in your favor, and if a trade goes against you, cutting your losses, and moving on to the next trade. Because if you try to adjust losing trades and you keep trying to win, that's when you get yourself into really large holes. And I cannot stress how important that is as a trader. So with that concludes what I wanted to show you guys here today. I know I covered a lot of things. I don't expect everyone to remember everything here, which is why we make both the recording and the slides available to everyone. And again, for those of you that have not registered for a free account here for Options Play, I highly recommend you to sign up using the link I just posted into the chat window, which gives you access to the full Options Play platform, the weekly options education webinars, the webinar replays like the one that we're going to do here today, and the weekly cover call and short put reports. So with that, I want to thank everyone for taking the time out here this afternoon. Like I said, I covered a lot of things. So after we finish here, about 30 minutes later, I will send everyone both the recording and the slides. And you can follow us on YouTube if you can't attend every single one of these webinars, and you'll just get a notification every time we post one of these webinars directly to YouTube, so that you can follow them along at your own pace. So with that, what I'm going to do is I'm going to open this up for Q&A. If you have any questions regarding entering an order, managing a position, anything along those lines, please type them into the chat window, and I'll answer as many questions as I have time for here today. Okay, so let's see. I've got a few questions up here. Can we have a PDF of this presentation? Yeah, so every single time we finish a presentation, you get the webinar recording about 30 minutes later. In that email has the slide presentation. So you can click download all of our slides after every single event. We send it to you in that email with the recording at the end. Seems like there were a few requests for the presentation. So again, that is always sent to everyone in the email afterwards. Richard, TA, Gills, Antonio, thank you so much. VJ. RK is asking, once again, Tony, another excellent presentation. You take a complicated subject matter and make it very accessible. Thank you so much, RK. I really appreciate that. Val is asking, in the case of a cover call, if I get this right, the owner of a cover call, once it's in the money, can choose to execute at any time before the expiration date. I was told so by a CIBC specialist. If so, should we really wait until the very last week before the expiration date in order to buy to close a cover call, which went in the wrong direction? Isn't that risky? So Val, very good question. Now, the reason that it doesn't make sense for the owner of the call to exercise early is because when they exercise early, they're basically leaving money on the table. Um, now, eh, basically, what we're saying is that if you can sell a call for 60 cents, why would you exercise it early and only capture 50 cents when you can sell it on the open market for 60 cents? So yes, you're right. Someone can exercise early, but monetarily, they actually pay more money if they exercise early, or they're actually losing money if they exercise early. So it makes more sense for a call owner to simply sell it at the open market than to exercise early. So that's why, generally speaking, it's not a risk to wait till the last week. It is a risk to wait till the last day, but within the last week, you should be fine. Patrick is saying, what is a rule of thumb for cutting losses? Patrick, that depends on the trade that you're in. So if you're long stock, if you're long a call or a put, you want to cut your losses at 50% loss. If you're trading a debit spread, same thing. However, if you're trading more complicated strategies like credit spreads, it depends. So we cover those rules for each individual strategy during our webinars. So if you want to learn more, you can follow us on YouTube. We actually have a YouTube Options Play Canada playlist. So you can follow us there, and we have a playlist that shows you all of our previously recorded webinars. So if you want to learn more about selling credit spreads, we talk about when the rule of thumb for cutting losses on credit spreads, debit spreads, all different types of positions. So if you want to learn more, look at the individual strategies themselves to learn more about when you should cut losses. Azim and Susan, thank you so much. John is asking, I enter an order into options play and I see the return and the POW, etc. But if I double the order and change the quantity, the return and POW goes to 0. I'm not sure what's happening here. So when you're saying that you're changing the quantity, it goes to 0. I'm not sure what you mean by that. Okay, so you shouldn't change the quantity on a cover call, because a cover call, you should really only sell the number of contracts that you own shares of. So you shouldn't sell 3 contracts if you only own 200 shares. So you should only sell 2 contracts if you own 200 shares. I hope that makes sense, because we can't calculate a POW on something where you've oversold the number of contracts that you sell. As you can see, there is no POW here because there is no chance of this expiring worthless, because you've sold more than you are able to. So you should not adjust that, in my opinion. If you're trading, you can obviously change any number of contracts. So if you're trading, 10 contracts, it'll still calculate your probability of profit, and you can use the P&L simulator the same way regardless of what you do. Anna, thank you so much. Claude is saying, hi, Tony. Still waiting your reply regarding real-time market data. Claude, I don't remember seeing that email. If you don't mind sending me an email again at info@optionsplay.com, I'm happy to answer that question. Val, Patrick, and John, thank you so much. I appreciate it. Any other questions regarding what I spoke about here today? Oh, looks like I have here. I have an account with TD Web Broker. Can I still use Options Play? Yes. Options Play is available to everyone. So you just have to sign up using that link I just posted into the chat window. I will post it again, Dorothy. Sign up using that link in that chat window, and you can have access to it, regardless of where you trade. What's the easiest way to watch your past webinars? So I think the easiest way is to actually go to our YouTube playlist. We actually have the playlist here where you can see all of our previously recorded webinars. I will post this to everyone in the chat window. We always make sure that the latest webinar is available here to you on our playlist. So as you can see, all of the topics that I've covered recently are on here, and you can utilize this to quickly find strategies. Dorothy, yes, it is always free. This is courtesy of the Montreal Exchange. The Montreal Exchange has paid for your access to Options Play. They have also paid for me to host these webinars so that you guys get access to all of this content, the tools, the education, the weekly cover call reports, completely free of charge. So you guys can send your thanks to the Montreal Exchange for that if you want to thank someone. Any other questions? Batter, thank you so much. I appreciate it. I'm glad that you think this beats a university finance class any day. I really appreciate that. I enjoy teaching you guys these topics. You know, I'm quite passionate about this myself. You know, I built Options Play from the ground up. We started this company 7 years ago with the intentions of helping people better understand how to explore, analyze, and trade options. And I've had the ability to run this company since then, and I'm love doing this. I do this for you guys, so please send the Montreal Exchange, you know, how you think about these webinars and the fact that you think that they're very valuable to you, because that means that they'll continue to do business with us and allow this to continue for you guys to have access to this content and these tools. So thank you so much. Claude is saying, do you happen to know why a stock like FFH does not have options? So the rules for whether a stock has options is pretty crystal clear, that most exchanges, they have different rules in terms of market cap, in terms of trading volume, in terms of liquidity. And you know, there are a bunch of factors that they consider. And once a stock exceeds those criteria for a certain amount of time, that's when they put them up for options trading. So you can ask the exchange what those rules are. They should be able to tell you. And I don't know FFH. I don't know whether or not it meets those criteria. But if it does, you can certainly ask them to list options on that. All the expensive, juicy stocks in Canada don't have options. So you can, again, you can ask the Montreal Exchange, you know, why they haven't listed it on a specific stock that you have in mind. I don't know of any. I'm not sure what you mean by expensive, juicy stocks, but you can certainly ask them, and they can usually share with you what rules they use to decide whether a stock is listed for options or not. CSU. My guess is because it actually trades very few shares, 43,000 shares a day. That's pretty low. Granted, it's a high price stock, but that's a very low volume. So my guess is it's related to that, which is probably why it doesn't list options. So thank you so much, everyone. I hope you guys have found this useful. What I will do is I will send everyone the recording in about a half an hour with the slides so that everyone can follow along. And again, please, if you want to, for all of you that have asked, you know, how can you see our previously recorded webinars? How can you follow us? The best way to do that is to follow us on YouTube. You can go to our Options Play Canada YouTube channel, click on subscribe. And what that will do is every single time we post a new video, you'll instantly get an email. So you'll always be across our latest content. Even if it's not a webinar, even if we do some off-topic things, you know, that's not a webinar, whenever we upload a video, you'll get an email notification of that instantly. So that's a great way to follow us as well. So thank you so much, everyone, for taking the time out here this afternoon. I hope you guys have found this useful. I'm actually back here next week. So I know we skipped a couple of weeks. So next week I'll be back, I believe, on Monday or Tuesday. And we will be doing another webinar here for you guys. So look forward to seeing you guys there. I hope you guys have a great evening.